Hey, welcome to Oregon Cash Flow Pro. My name is James Barber. As always, here to help you maximize your cash flow. And lately, we've been talking a lot about cash value life insurance because it's kind of a big aspect to ways to safely manage our wealth. Good place to store our wealth. And I'm a big fan of it. Obviously, I'm an insurance agent as well. That's where I make my money. But I'm here to share with you everything we can about that. Clients, agents, you're all welcome. Happy to have you here. If you have any questions during this live stream, leave them in the chat. We're going to do our best to answer them. We're going to be looking today at the Allianz Life Accumulator IUL. This is a new one. Today is the first day that this has been available. It just came out. We're able to do some illustrations with it. So we're going to do that during today's live stream. Let's see. Okay, if you want to leave a question during the live stream, you just need to be a subscriber. So click that subscribe button down below and you'll be able to ask your questions while we're going through this product. So we're going to go through it. We're going to go over the new sheet, which you can see right here. Right there. You can see the new sheet right here that tells us a little bit about it. We're going to look at the new index options that are available. We're going to talk about the details, and then we're going to do some illustrations, and we're going to look and see how does this compare to the old product that's expired yesterday. So we just found out about this product last week. I think it was sometime last week. And they're instituting it really quickly. So one of the first thoughts that I had was, what's going to change on it? Because I actually just started a policy on each of my girls with that old product. Well, I was in the process of it. One of them we just completed. The other one we're just getting ready to finish signing. And once I got that notification, I thought, oh, you know what? Let's hold off. We're going to take a look. We're going to illustrate both of them as soon as they come out. And then we'll decide which one we want. I have a client that has a couple of policies ready to go. We put those on pause so that we can see what this does here and decide which one we want to go with. So you might find yourself in a similar situation. Hopefully this will help you out. Let me just do a quick sound check. If you can hear me, leave a comment in there. Otherwise, I'm just going to go to my phone. We're going to take a look and see if everything is coming through okay. All right. It looks good. Sounds good. Let's talk about this new product. If you've paid attention to my channel at all, you know that I'm a big fan of the Allianz IUL. There's a number of reasons for that. One of those reasons is they don't reserve the right to change hardly anything about the product. So when we buy this and we plan on accumulating cash value over the next 2, 3, 4, 5 or more decades, we want to know that it's going to be the same product then as it is now. And what we like about it now will still be in effect there. A lot of carriers reserve the ability to change the load fees, change the crediting, adjust what they can pay you for the loans or what they'll charge you for the loans and what they credit you for the loans. They can adjust bonuses or do away with them entirely. They can have an account value asset charge, and those numbers can be changed. There's all kinds of things that can change inside these things. Allianz doesn't reserve the ability to change any of those things. So we really like that about this product. In addition, they don't profit off of their index options. And so we tend to see better bonus options, better cap rates, better participation rates across the board. Better fixed interest account. So if you didn't want to be in the market for a given year, you get better crediting. So we're going to take a look at all this stuff in today's video. And if you are interested in anything specific for your situation, feel free. There's a link in the description to my calendar. It's my Calendly. It's calendly.com/cashflowpro. and you can schedule a one-on-one with me. I love talking with you guys one-on-one. All of my videos do a good job of talking about concepts and giving you ideas on how things work. But when we meet one-on-one, I can specifically answer your questions and we can design things for your situation. So it works really good. It's obviously the next step in the process once you get a little bit farther in the education of these things along the path of getting one. And I do sell these things. I not only design the best policies, but I sell them. So I would love to work with you if you're interested in getting one of these things, either IUL or whole life. I love them both. I own both. But let's see what this one has to offer. So this is the Allianz Life Accumulator IUL, their newest innovation. Now, I don't see a whole lot of difference between this one and the prior one, but we do get a few extra things to go along with it. Chief being, we have a couple more lockable index options. So they're blended futures index and the S&P 500 futures index ER. ER, that's a excess return index. It's a volatility index. This one actually has some really good growth numbers to go along with it. I've never been a big fan of the blended. Prior to this one, they just offered the blended. It wasn't based on futures. One of the reasons that investors are tending to look a lot more at futures, big time investors, is they're accessible 24 hours. There's the ability to do more with futures. And I think the prices, you don't have the decay on options that you do with regular options. So there's advantages to using futures as opposed to just regular options, which is what most of your IULs are based on, or how they hedge in the normal IUL. We've got an additional bonus opportunity. So it was a 0.9 guaranteed bonus in the prior product. Now we've got now we have a full point. So 1% guaranteed. This is great because when we design these policies to have optimum cash growth and we minimize the expenses later on, when all of the critics of IULs, when they talk about the expenses getting too big and it's going to blow up the product. Well, when we minimize those to optimize for cash growth, the expenses are going to be like 0.1 or 0.2% of the value in the policy. So if we're getting a 1% guaranteed growth, so even in the worst year, we're gaining way more, 5 times more than what the expenses might be inside that product. These products aren't going to blow up in that situation. So as long as we have a properly funded design, these things are amazing for wealth accumulation. So we've got the index lock. That one carries over from the prior product. They're adding in the ability to set a lower target value. That's like a stop loss. Previously, so in the old product, and this might carry over. These options might carry over to the people that own the older product. Allianz is really good about extending new features to the prior product, as long as it's not something that's going to cost them a lot different than what they're allowed to charge for expenses based on the older contract. So previously, you could set an upper target or you could lock it immediately at the end of that day. A couple of years ago, I set the index, PIMCO index was a little bit under 13%. And I said, lock it in if it goes above 13%. And like the next day or a couple of days later, it locked in at 13.52, wherever it ended the day when it triggered the lock because it went over 13%. So that's setting the upper target. I could have just locked it that day and I get whatever it finishes the day at. They've added the ability to say, hey, if this thing goes below, so I could have said, if it just goes below 12%, let's lock it in. Because I don't want to miss out by setting an upper target and then having it just go down, 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 down. And if you traders out there, you know what I'm talking about. You see a target in mind where you plan on selling, and then it never hits it, and it just falls. The value of your stock just falls. So it's nice to have that lower target value in the case of a black swan event. And then we still have the flexible designs that are available. So nothing much new here except for the lower target values, and then we get the 1% bonus. That's pretty great. All right, just checking the chat to see if anybody's leaving any messages. Say hi if you're watching. It's always nice to have some folks check in. All right, let's see some of the details here. Like I said, most of this is not going to be different from the prior product. I took a brief look at this. I haven't done any illustrations, so when we get into the illustrations, these are going to be brand new, and we're going to look at it, and we're going to compare the expenses of the old product to the new product so we can see what kind of tweaks might have happened. Because really, we know we're getting a little bit more in this product in the way of the ability to set that lower target, the extra bonus, so the extra 0.1 on the bonus. All of the index options look like they have the same caps and the same participation rates as the prior product. So nothing changed in that regard. But we're going to want to take a look and see, did the expenses change in there? Because that's going to help us determine which product we want to go with for those of us who have a policy or an application in process that allows us to choose between the two. Now, as of today, if you're going to start a new one, you only have this new product. But I think there's still value in understanding the differences because it kind of tells us the direction that a life insurance company goes. When I see a life insurance company that's instituting new products that are kind of moving the wrong direction, meaning the expenses are getting higher, they're doing away with bonuses, maybe they're lowering the cap rates and the participation rates with the new product, things are changing in there, and that doesn't seem to be changing to the better. And so that's going to be a little bit of a red flag that I'm going to want to pay attention to. Because that could indicate that something's going on with their general fund account, right? Okay, so you have accessing the cash value, fixed interest loan, an index loan, and withdrawals. Same thing we had with the prior product. Accessing the death benefit, we still have a chronic illness and a terminal illness. Now, Allianz has been in discussions with us about offering a third living benefit rider like some other carriers offer, which would be a critical illness rider. If they do institute that, they have said that they would likely apply it to recent purchases. How far back they go, it probably just depends. These tend to be pretty comprehensive, though. The critical illness just adds a little bit more detail. Probably covers just a couple of extra things. So I'm not too concerned in general. If you've ever talked to me, I'm not too concerned about the living benefit riders. These play a big part in the early years, or I should say they could play a big part in the early years where we're paying for more death benefit. But later on, when we're optimizing for cash growth, we're minimizing that death benefit, that amount that's at risk above and beyond the actual cash value that we've built into these things. And that's what these access. These access the cash value. These access more than just the cash value, potentially up to the full death benefit or very close to the full death benefit. Well, if we're minimizing that, that means there's less to worry about in those later years as far as the living benefit riders. Our main goal is cash growth in these things, and unless something changes with our health, these are going to play a smaller part in the later years in our expectation. Okay, so we do have some extra riders that are available. Really, the biggest rider that we pay attention to is this one. and this one. So the loan protection rider is what gives us the ability, if we're unhappy with the product or we accidentally borrow too much money out of the product, we can just trigger that loan protection rider and walk away with our cash value. And that the insurance company is going to maintain a small death benefit until we pass away. That way we don't get dinged with a tax bill. So this one is important in most situations. Now, I don't expect we'll end up using it. I don't expect that you're going to want to use it because you think the expenses are getting too big in the policy, because the expenses are generally a reflection of the total account value and what we have to buy for insurance when we get into older age. And like I said earlier, that should be a very small fraction, like 0.1 or 0.2% of the cash growth inside the policy. So it's not my expectation that we're going to use the loan protection rider, but it's good to have just as a pull the ripcord in an emergency type of situation. And then that supplemental term rider. The supplemental term rider is what we use to reduce the expenses, to reduce the expenses inside the policy. That supplemental term rider is the key to a high cash value design. It's what puts more money into your pocket as opposed to my pocket. It brings that target premium down, and I'm going to go over the expenses when we look at this, and you're going to see what I'm talking about. I don't usually use this one. It's a waiver of premium. This one usually kicks in if you can't do your job anymore. It's a very inexpensive rider to add. It's not just your job, but it's any job. You can't do any job. So it's very inexpensive, but that's because it's rarely employed. So you can get it, you can not get it. I don't think I've had hardly any clients add it to their policies. Just based on what they're planning on funding it at and the expectation of how long they're going to fund it at and what are the odds that they're not going to be able to do any job during that time period. So don't use that one very often. The enhanced liquidity rider, this one does away with the surrender charges. Well, when we blend in the supplemental term rider, we're minimizing those expenses, and the surrender charges are also minimized. So they're not very much. So it's not usually worth it to pay for the enhanced liquidity rider in that situation. I think I've had one client that included the enhanced liquidity rider in all the years that I've done this. And that's basically because of what they did, which is go knock on doors in neighborhoods that are very inexpensive where they could buy a house for just a few $1,000s cash. So having access to every penny could have meant the deal between getting a deal and not a deal. And they make way more on one of those deals than the cost of this rider. Well, for most of us, having access to a couple $1,000s isn't that big of a deal. It's not going to make or break any of our other investments. And so that's usually the metric that we use, whether to use the enhanced liquidity rider. You tend to see the people that use this enhanced liquidity rider are people who are doing premium financing, and they're paying big commissions because they're not getting this supplemental term rider blended in that reduces the expenses. Well, when you pay the big commissions, there's big surrender charges. Now, the enhanced liquidity rider costs a lot more in that situation too, but those agents generally aren't explaining this to their clients. So this waiver of new charges benefit, there's no cost to that one. That one's just automatically included. It has to do with the policy being 10 years or older. And if you make a change, you're not going to end up with some new charges based on that. So nothing different as far as the riders for this new product. Now this one is different. Here's our 1% bonus, and we can see which index options you have to choose from. It used to be that you would only get these bonuses with these two and then a blended index. It wasn't the blended futures. So we get an extra one. We now have 4 options to choose from instead of 3, and 3 of them look very attractive. My 2 favorite are the PIMCO and the S&P 500, just based on what we've seen for growth and what's been happening in the rising interest rate environment of the last few years. Bloomberg hasn't reacted very well to it. It's been struggling a bit in the rising interest rate environment, whereas PIMCO's done very solid. Have not been unhappy with the returns on that one. This one looks pretty solid, and I'm going to show you what that one looks like. The S&P 500. We're going to look at this one, this futures index ER. I have a chart pulled up that we're going to share here in a little bit. Actually, it might be a good time now to take a look at that chart. Let's pull that one up. Give me just a second. Here we go. So this is the S&P 500 over the last year. This is year to date. We can see it was here at 420 at the beginning of the year, and now it's up around 488. This one's not giving us the total growth over the year, but it was really good. I mean, we can see how it's good. It's just not telling me the numbers right here. It was comparable to the actual S&P growth, which is really good. It's not quite up there, but it's really good for being able to get that downside protection inside of these IULs with this. Let's go 1 year. So for a year, it was 421, and now we're at 488. That's something like, let's just do the calculator real quick. That's like a 14, 15% return. Yeah, almost 16% return in a year. That's really good. Let's see what we got. Okay, so this doesn't have 5 years of history. It looks like it just started at the beginning of this year. So that's something to take into consideration. They've done some back testing, like most trading options do. They're going to do back testing to see how these things do. But even after they started this, like really good growth throughout the year. Now, I don't worry too much about trading options that have been back tested. Obviously, we're not just going to assume they're going to continue working like that in the future, whatever the back test says. But just because it's been back tested, it doesn't mean that it's not going to do well in the future. But you got to pay attention to it. We're not just going to blindly follow it because it looked like it's supposed to work. But back testing is what almost every trader does when they come up with a plan, when they come up with a strategy to make money in the stock market. They're going to back test it first and see how would it have done throughout certain periods. Well, some IUL critics like to complain about new index options, the opportunities for making money in here, and that it's based on some back testing. Well, that's how most people in the stock market end up making money. They do some back testing first, and then they put it into practice. All right, this one is a neat one. This one was available in the prior IUL as well, and this is the S&P 500 index. There's the annual point-to-point with a cap, and then there's the monthly sum. I'm not a big fan of the monthly sum, but the trigger method is a very attractive one. The current trigger is 8.25% interest. What that means is if the S&P 500 index over your annual point-to-point is greater than or equal to 0 for the year, you automatically get that 8.25% interest. That's pretty cool, especially if you think that the S&P might be down or flat. That one's a good option where people are hedging and getting a little diversification. The annual point-to-point with a cap, I think the cap's somewhere around 12.5%. That is one of, if not the highest caps that we have available out there that doesn't cost you extra money in all the other IULs. There are some IULs that offer you a little bit better cap, but you're going to pay either an account value charge, so you're going to pay extra based on the value inside of your account, or you just pay extra for either a higher cap or to make it uncapped, right? There's some things that you can do that you can pay extra for. This one doesn't, these don't cost anything extra. We have 100,000 minimum on this product. That didn't change. We've got 3 different benefit options. We like to use the option B. It makes sense in almost every cash accumulation goal situation where we're going to use the option B. There could be some scenarios, especially for some older people, where option A might work out a little bit better, but our MEC limits tend to be a lot lower with the option A. So it's going to depend on your situation and your funding. Option C, basically you get the MEC limits of option A, and you're going to kind of get the growth and expenses of option B. I've never used option C. It's really not a good option in my opinion. So yeah, if you ever want to talk about that, let's talk about it. I may do a specific video on why I oppose it, but we're not going to talk about that one anymore on today's video. Just know there isn't really a scenario where I see that one being the best option. Index lock. So we talked about that. They have upper and lower targets. That one's great. Issue age up to age 80. Now I found a typo on their website here. It says maximum premium, $25 a month, $300 per year. This is actually the minimum premium. So they're going to need to get that fixed. You got all the same different payment options as any other IUL. Let's see. Survivor benefit increases 10% if they take the proceeds over 10 years or longer. And then there's your different risk classes. Now, one thing Allianz is still doing is they still have their automatic upgrade program in effect. So if you qualify for standard or better, you automatically get the preferred plus. That's only available for 18 to 80. It doesn't affect juvenile rates. But if you qualify for anything less than standard, right now I think they still bump you up 1 rating. It's a really neat program that they're doing here. And this is one of the reasons I like Allianz as well. I mean, it's the reason that they're doing this is because their general fund account, when the interest rate environment went up, their general fund account has been doing really well. And this is one of the things that they decided to do with that extra cash. Not only did they give us better bonuses or better participation rates, better cap rates, and a better fixed rate, but they also said, hey, let's put some money towards giving a bump up on the health rating. So if you're somebody that gets standard, and this is where it's been really interesting, is when I've got people who might be just a little bit overweight and you wouldn't normally qualify for preferred plus. So let's say you're 6 feet, 280 pounds. And that might put you in the standard class. Like you could be healthy. Like you could be that because you're an athlete and you're fit and you work out and your body weight index, it's just not going to be where insurance companies like it to be to get a preferred plus, which might be 6 feet and under 190 pounds or something like that. I don't know if those numbers are accurate for the class. I'm just giving an example, but you could qualify for the preferred plus even though your BMI puts you into a standard rate class with any insurance company. So pretty neat feature. If you're interested in taking advantage of that, they've extended that program through the end of the third quarter. All right, let's move on. Let's move on to looking at the actual product. Here we go. So I've got an illustration set up and ready to go. Agents are going to like to see how we do this. This is where we blend in the supplemental term. This basically just covers the setup. We have an increasing death benefit until about retirement age, so age 65. Then we're going to switch to level, and we're going to go to the guideline minimum. That's how we optimize for cash growth. Over here are all of our numbers. We can see our MEC limit is $16,000 a year for this product. Target premium is only $1,000 on here. Okay, $600,000 in death benefit and $1,000 target premium. That's really good. This is one of the best products as far as us being able to squeeze down that target premium and being able to dump in a whole lot of cash. And then our minimum premium on this, $1,157. The advantage of the IULs is that flexibility in what you have to put into it in order to meet a no lapse guarantee and what you can put into it. So if you feel comfortable putting in a small amount, but knowing you have the ability to dump in a much larger amount, these can be good for that. Let's go to the index options. So these are the different index options available. We've got the select. This one we pay extra for, but you get a 40% multiplier. We could illustrate up to 7.42 on a lot of these index options. I always dial it down to 6. I prefer to have a 6% assumption. There's a 15% multiplier available, and then we have that 1% guarantee bonus. Again, on the old product, it was a 0.9 guarantee. So I'm setting up 50-50 between PIMCO and the S&P futures. And let's take a look at this historical data. Here's the historical data on this. Now, remember, this does include back testing, but we've got some really good numbers here on the back testing for that S&P, even on the classic here. Good back tested numbers. And then here's our PIMCO. Now, the PIMCO has been around for, what, 6 years, 7 years? So this one's a little bit of back testing. But a lot of it is actual experience. So it's done very well over that time period. Same thing with the Bloomberg. The Bloomberg's been around for about that same time. The ER version of these. These indexes have been around longer than that, which is partially why they're able to get back testing farther out. The PIMCO has been around for a while. But the ER version of it, I think, has been around for 6 years, maybe a little bit more than 6 years. So those are the numbers based on the historical data. Let's see. Yeah. All right. If you got any questions about that, leave them in the chat, please. Let's go back. And let's look at the actual illustration. Okay, so, oh, hang on a second. This is the old product. This is the old product. Okay, we're going to look at the expenses, and I'm going to do an illustration on the new product too. So let's go back here. Let's create the illustration, and we're going to compare the two. We're going to offset these just a little bit so I can switch back and forth between the two. Let me get down to the expenses. We're going to see if anything's changed here. Here we go. Policy charges ledger. Anytime you get an illustration, make sure they include the policy charges ledger. It's a great way to understand what's going on inside the policy. Should not get hidden. Okay. So it looks like we've got a... Oh, wait. Let's go back up here. Is that the first year in the policy charges ledger? It is. Okay. So we have a higher load fee in the first year, and then it drops down after the first year. That's interesting. Let's go back to the old product. This is the new product, by the way. Can I get that? It's really hard to get just a small adjustment here. But anyways, this is the accumulator. When we look at the old product, check this out. We have a premium charge. So they have an 8% premium charge for 9 years, and then it drops to 4%. What we see here, this looks like a 9% charge for the first year. And then it's going to drop to, what is that, 6%? 816 divided by 16, 3, 28, 52. 5%. So we got a 5% charge after that. I like that. That's actually really attractive. And it stays 5% forever. Now in the old product, it was 8% for 9 years, and then it's 4% forever after that. So pretty cool. Not a huge difference, but we do save a bit during these years on the new product. Okay, let's look at the per unit charge. This is where they're going to, well, the policy fee was the same. That's the documentation fee. Let's go back up. This is your documentation fee. And then we have our per unit charge. This is where they're going to recoup the target premium. Target premium on the new product, right here, $1,090. We're still at $343. Target premium, this is the old product, $1,090. No change. No change from the agent side on what we're going to be making for a commission on this product. Okay, cost of insurance. Here's the new product. We've got, this is age 17, which is the end of the first policy year. We've got a total of, with this blended design, $190 for our insurance. The old one, oh, we got a little bit of savings here. Cost of insurance. Looks like it's a little bit less for the supplemental. For the base, it looks like it's the same charge, $26. Yeah, same charge on the base, a little bit lower on the supplemental. So we went from $209 to $164. Does that maintain down the road? Let's just look at the total charges. By year 20, total expenses. Oh, mech limit went up slightly for this product. So the mech limit is a little bit higher. So we're not going to look at the total for the premium charges because that's a load fee. It should ultimately be, we're at $18,739. This one by year 20, we're at $16,982. So we're a little less, even though we've put in more money. That's because we're better off having that 1 year be slightly higher, and then these years are all slightly lower, even though these ones are slightly higher. Because we get a lot more growth and compounding on the savings that we've accrued throughout this time period. All right, so let's go to the rider charges. Total after 20 years, $4,248 on the new product. On the old product, $5,589. It's about $1,300 in savings. And cost of insurance, $1,350. That one is a little bit higher on the new product, $1,443. So what's that? $1,350 to $1,443. It's just under $100 more on this side, but we save about $1,300 on this side. No, wait a minute. This one's $42.48. Yeah, that's right. This one went to $55. That's right. I was thinking I was mixing these two up. Per unit charge, $5,837. Per unit charge, $6,022. So slightly higher, $354. Oh, and $343. So it is slightly higher on the per unit charge, even though we have the same target premium. So slightly higher the amount that they're going to recoup over that time period on the new product. So that one went up slightly, not very much, but slightly. This one down significantly. And then this one down significantly. Overall, we're looking at 30,000 over 20 years and 33,000 over 20 years. So we got some savings on the expenses. All other assumptions being the same. Oh, I know why I'm not seeing your messages. Let me go to... Hang on a second. I was wondering why nobody was saying anything, but I think because this is a members only or a subscriber only, I might not see your messages. Well, we'll take a look at it later. We will take a look at it later. I don't think I can access that with where I'm currently looking at stuff. Hey, Amir, how's it going? I can see it. Oh, no, I just closed my browser. Dang it. Didn't mean to do that. Hang on a second. I gotta pull this thing back up. Oh, it closed all my browsers out. Did I go over everything we were looking at? I don't think I need the browsers open anymore. Hang on a second. I think I covered everything I'm looking to cover. And looking at the indexes, or looking at the illustrations, let's pop those back up here. Not that one. That one, there we go. So looking at the illustrations, I think I like what I see from the new one. Essentially, the way that I view these little bit higher expenses on the per unit charge is why we're getting the 1% instead of the 0.9% for the bonus. We're paying just a little bit extra here. We're also getting we're paying a little bit more on a load fee on a long-term basis. So if we go out, let's go out to age 65. Well, let's just say both of these are going to get funded through age 65, max funded. Where did the expenses end up? We're at 171,919 on the new product, and the old product at that same time 177,380. So 177,380 and 171. So about 6,000 less in expenses. If funded the exact same way, and we have the same assumptions everywhere else in the policy. That's pretty good. I think I'm going to be switching to this product for my daughter. What do you guys think? Like I said, leave your questions in the comment section below. If you're watching this live stream, I can answer them right now. Or if you're watching this afterward, I will be answering questions. Amir asks, can you switch from the old to the new one? No. If you currently have an application and product process, you can. If you just got approved and you're still within the free look period, you will likely be able to switch it. So I'm going to find out, because I'm going to see if I can switch it on my other one, my other daughter's policy that I just started within the last 30 days. So I think I'm still within the free look period. Some states, that free look period is 10 days. Some states, it's 30 days. So I'm going to have to take a look at that, because I think I would like to switch to the new product, because I would like exposure to that new S&P futures ER index. I think that's pretty good. And then having the 1% bonus instead of 0.9, obviously that's a little bit better as well. Here's the growth potential on this if you're interested in looking. Now, from a guaranteed standpoint, anytime we're showing these illustrations, they like us to show you the guarantees. Guarantee assumes no growth in the index ever. So if we max fund this policy and we get no growth in the index, we're still going to get some cash growth. We're just not going to be getting any credits other than that 1% bonus. Okay, so here's what that looks like. Obviously, the cash growth is not going to be attractive compared to what we funded it at. 40 years into it, you put in 646, you got 560 in there. Okay, that's not great. It's not a great investment at this point. But what are the odds that the indexes get 0 every single year in the policy? They're not. That's not very likely. Well, does this policy lapse in this scenario? Here at age 88, this is showing the policy lapse because the policy charges, we're paying for basically a ton of insurance. For some reason, in this scenario, when you look at the guaranteed, it doesn't reduce the death benefit. It's kind of strange. I don't know why the illustration doesn't show a reduction in the death benefit. It does a little bit, but what we're going to notice is this reduction probably matches the reduction in the non-guaranteed scenario. So I usually don't put much stock in when we see guaranteed scenarios because it assumes like you're never going to make a change to adjust for the indexes totally underperforming the whole time. And you're just going to let the cash value eat this thing up. Like you could do a 1035 exchange at any point in this policy if the indexes are not performing. You could 1035 into a whole life, get the guaranteed growth. You could 1035 into an annuity and get whatever advantages you get out of the annuities. So there's all kinds of things you can do in these rather than this index option play out. Or I mean, rather than this guaranteed scenario play out. Now on the non-guaranteed side, this is assuming, remember, 6% growth. This likely includes the 1% on top of that. So if you were to do the math on this, you're probably going to see numbers that show that you're going to be accruing at 7% growth, unless it's going to limit us somewhere in there. Sometimes these illustrations will limit it to a maximum growth. Now we have an assumption of a 6% growth, but then we have that classic bonus of 1%. So by the time we get to 65, if everything plays out that way, we funded it. Oh, this is the old product. Let's get back to the new product. The new product is the one we're interested in looking at. Well, on the old product, let's just look at the growth. On the old product, the growth by age 65, we put in 791,000 total. We're at 5.5 million. Not bad. Not bad at all. I can get with that, which is why I decided to buy the product, right? Here with the new product, let's go back to the guaranteed illustration for the new product. Okay, guaranteed scenario, all the same thing. It assumes 0% growth every year. By the time we get to age 65, quite a bit more money in there than the other one on the guaranteed basis. Quick reminder, this one on the guaranteed side at 65, age 65. Oh no, 666. For some reason I was thinking it was in the 500. 666, 082. Oh, this one's slightly less. Slightly less. Probably because we funded it a lot longer and a little bit higher. And we had that 5% load fee. So very, very close, but slightly less on the guaranteed in the new product. On the non-guaranteed, because this one assumes a 1% bonus and the other one's a 0.9, this one should be higher. And we know the expenses are lower. Okay, non-guaranteed by age 65. In this case, we put in 800,000. The old one, we had funded it at 791. Okay, and we were at 5.5. New product, funded at 800. We got over 300,000 more in potential growth. We funded it 9,000 higher. We got, what was it, 6,000 less in expenses by this time, under the assumptions that we're making. And we got 300,000 more, 340,000 more in cash growth. I'm thinking this looks pretty attractive. The loan options in this product, same as the old product. Let's see, that's not the loans. Does it mention the loans in here? Here we go. It's 5%. That does not change. Okay, that is a fixed loan rate. Now, this is a participating index loan, which means it won't affect the growth in the policy. Your alternative to that is your wash loan. For the first 10 years, it doesn't wash. They charge you 2.91%, and you get a credit of 2%. So when they say fixed and indexed, this has to do with the crediting. The fixed loan means the crediting is fixed at 2%. What they charge you is going to vary depending on if it's within the first 10 years or 11 plus. It's a 1.96. So it's an upfront charge. It basically plays out to be a 2%. So that's how it ends up being a wash loan. So we don't assume any arbitrage. In fact, you get a negative arbitrage in the first 10 years with the fixed loan. This is the type of loan we would expect to use late in retirement when the loan balances start to get high, and we don't want to make an arbitrage play between our credited index interest and what we pay to borrow. Early in the policy, we look at this as a line of credit that costs us 5%, and we're going to use the participating index loans, and it's fixed at 5%. That will not change. So generating or building up cash value in this product is like you creating a line of credit for yourself that you have access to at 5% for the rest of your life. Or at least until we switch over to start using some fixed loans. Now, Allianz is unique with the loans in that they will let you hold both loan types at the same time. Hey, RJ, is the term blend still 10 to 1? I didn't see a note. I didn't see a change in the term blend. That's a good question. Let's go back. Let me pull up that illustration software again. I accidentally closed it all. Let me log back in. So for juveniles, it didn't change. It was 5 to 1, still 5 to 1 for juveniles. All right, let's make a change to our assumptions. So instead of a 16-year-old, let's make it a 18-year-old. And we should be able to do the same 10 to 1 blend. That means 100,000 here, a million here. What happens if we do just a little bit more? We get the error. So yeah, it is still 10 to 1 for an adult. Now, it was 10 to 1 up to age 50 in the prior product. I assume it's going to be the same. Let's make this a 51-year-old. And we should get an error. We do have an error. So it's still 5 to 1 for juveniles and adults over 50. Good question. We're going to wrap this up in just a few minutes. So if you guys got any questions, now's the time to ask. We've covered quite a bit about these products today. And it was I didn't give you guys much notice that I was going to be coming on live either, so I'm not surprised that we don't have too many people hopping on here asking questions at this moment. So be sure, if you're watching this later on, leave your questions in the comment section. I'll answer them best I can. I might even do a video about it. We are doing videos to answer questions if it looks like it's a question that warrants its own video that a lot of people are going to be asking, and they're probably not going to be searching comment sections for answers. So appreciate you guys all joining us for this today. As I said earlier, if you want to get together with me, do a one-on-one comment, or the description. The link is in the description below under this video, where you can schedule a meeting with me. Just use my Calendly. It's calendly.com/cashflowpro. You're welcome, RJ. I hope it's helpful. I know we get a lot of potential clients that watch this. We've got past clients that watch this channel, but we also have a lot of agents that watch this channel, and I'm happy to help out whoever needs the help so that we can design and sell better policies. I think it's good for our industry if people are buying better designed policies, because there's a lot that these things can do, and I don't like all the hate that comes about. But every time I see a really bad design policy, I understand why there's a lot of people that don't like these things. Like, these can be designed with too much expenses, and the likelihood of success goes down the greater your expenses are. So, something to be aware of. But if we know better, we do better. And I think there's a lot of agents out there that have really good intentions and want to do better. They just don't know that they can, because they don't get trained that way. So, appreciate you guys joining us. Take care. We will see you guys next time. Have a good one out there.